Welcome back to my channel, Balance Sheets Matter. In this video, I'm going to be going over the proposed acquisition of eBay by GameStop. And you can see here, I already have a little Excel sheet where I've broken a lot of stuff down. This is based on what kind of the valuation would need to be for the acquisition for eBay holders to probably accept it. And based on that, we can then also basically project what type of returns both former eBay shareholders and current GameStop shareholders could potentially receive in the future. And eBay is a stock I'm quite familiar with. If you go back in my channel, you can see about 2 years ago, I did do a stock analysis on it. So, make sure to subscribe to my channel. Balance sheets matter here. And when I did do the video, eBay was trading around $45, and I did think it was quite a good valuation back then. I had bought the stock, but I did sell it approximately at $95 back in 2025 because I was thinking it was a little bit overvalued. And if we basically go to eBay stock here, based on the type of valuation I was doing, I felt that, looking at, for example, the price to sales ratio, this gives you a good idea of what the relative valuation is. And you can basically see right now, sitting at 4.22, about right here, it's a little bit on the higher side. That's pretty similar when I sold it. And if you compare all these previous points in history, the stock was a little bit more on the expensive side. And that is one of the reasons I decided to sell the stock. So right now, it does basically look like Ryan Cohen is looking at buying eBay a little bit on the pricier side because he is talking at buying it at $125 a share. But the trick is this is partially with cash and stock compensation itself of this new GameStop eBay company. And basically, this is where my little Excel sheet I've created comes in, so we can kind of, break this down and see what this would look like. Because I've kind of looked at this as several different ways to come up with a realistic valuation of what would be the hurdle for eBay shareholders to accept and what therefore both returns from both parties would look like going forward in the future. So basically, I'm going to explain this out here and kind of show you how we can actually change some of these numbers, and everything will change since it's all variables. So basically, at the current time I'm doing this video, the market cap of GameStop is sitting a little bit over $10 billion. But they basically have a little bit over around $9 billion of cash, most of which is going to have to be used for this acquisition, because at the $125 per share, basically half paid in cash, that comes from $20 billion of TD debt, and then they're going to have to come up with $7.75 billion themselves, which is almost all their cash. So if we take out the cash, the actual company value of GameStop itself is worth about $1.65 billion. And if we look at basically the income from operations, they do have about 286 in the last 12 months. If we apply a 25% tax rate to that, they're left a little bit under $215 million of net income, basically valuing the current company at about 7.7 once we basically take out the cash. Because if they do this acquisition and the two companies are merged together, they won't have the cash and they won't be earning that additional income expense. And basically eBay right now, well, the stock is basically varying in price. When I put this together kind of this morning, it was trading at about $46 billion market cap, a little bit over, at 105.16 per share, which it's pretty close to what it is when I'm actually currently doing this video. And their net basically income, and this is accounting for some discontinued operations, was sitting at $1 billion, well, just under $2 billion, but they're trading closer to a 24p ratio. So I made a blended P ratio of basically looking at the PE of this portion of their net income and eBay's net income, and the kind of blended PE would sit around this 22 PE ratio, which we'll kind of need for some of the valuations as we go on later. So the next little part of this Excel sheet here is basically the required eBay stock compensation, because they're going to pay, $27.75 billion in cash, and that's equivalent to $62.50 per eBay share. But the other portion of it is going to basically be paid in stock. So we have to look at what the basically combined value of these two companies would be to make it make sense for eBay holders to actually get that type of value in them. So one type of valuation method you can do is pretty simple. You just take the market cap of eBay, you take the market cap of GME without the extra cash, you minus the debt out, and then basically we get this value right here. And if you want to add an extra $1 billion of cash in because they didn't spend all their cash, you can do that. And basically, the other thing I have here is what is the percentage of this new company would the eBay shareholders get? So if we were to give them 50%, so this would mean that basically this new GME eBay entity, the current GameStop holders, they would own 50% of it, and the old eBay holders, they would own 50% of it. This wouldn't be very basically attractive for the eBay holders because you can see based on this type of valuation method here, the amount of share value they're receiving of this new company based on this type of valuation here is really only equivalent to just under $27 per share when they're effectively being promised $62.5 per share. Where in comparison, basically, the GME holders, they would realize, a 33% increase in their value of their shares. So in this type of 50-50 split, I do not think basically eBay shareholders would accept this. Most of these are owned by institutions. And this is why a lot of the institutions basically are talking that, oh, this would be about 70-75% dilution for GME. So this is something we can change. Let's put in 75% here. And you can see now this basically gets what the eBay shareholders receiving in value is equivalent to about $60.41 per share, which is much more in line of this $62.50. So this is kind of the general type of dilution that has been talked about and would probably be required to actually get eBay shareholders to accept the deal. And with this type of merger, basically, the GameStop shareholders would receive a 33% haircut kind of like right away. So you could expect, GameStop shareholders after the shares are kind of merged and whatever other, splits or this or that or combinations have been done for the stock to go down about 33% from its current value. But this is just kind of the hypothetical value to base on the shares. In reality, you kind of need to look at, well, what would the market price this company at going forward? And that's kind of another way to look at it of basically what would the value of the company be? Because this is all nice and everything, but they're taking a lot of debt and to basically get $20 billion of debt for a leveraged buyout, that does come at a little bit higher interest rate. So I have one proposed interest rate at about 8%, another proposed interest rate about 10%, which basically puts their debt, their interest expense they would have to pay about $1.6 billion to $2 billion. And kind of it's like, this is the proposed value that may happen if this merger were to happen. There was 75% dilution, but I think potentially based on these, the share price may actually revert down to more of how much net income they are basically producing and a fair PE. So I'm going to use this blended PE ratio. And right now, this is basically eBay's and GameStop's net income before any taxes. And if we were to basically take the 8% interest rate, well, they would be left with a little bit under $1 billion of net income before taxes. And at the 10% interest rate, they would be left with 557 million before taxes. And then if we apply a 15% tax rate, because GameStop basically is a little bit higher, but eBay is a little lower, probably a blended tax rate of 15%. And you can see basically they would have either 813 to $473 million of net income if we basically took these two companies, applied on this debt, and that's what they would have today. Because basically none of Ryan Cohen's proposed cutting solutions can happen day one. If you actually look at GameStop here, which I'll just quickly pop back into that, this transformation of GameStop, or basically, right sizing is really more what it is, did not happen overnight. And if I can get this to load here, let's try to refresh. Just 1 second. Okay. Anyways, it's not loading, but it took 5 years previously for GameStop to basically, from when Ryan Cohen took a position in the company, to basically start show the net income it has today. So it may take a similar time in the future for eBay, or maybe a little bit less. But in the future, I'm also going to be looking at what are the returns the shareholders could potentially expect to see based on his proposed plan under a few different scenarios. But basically, back to what we have here is if you kind of apply on what the market may reprice, not considering like the actual valuation, which eBay shareholders, a threshold they would actually accept to require this acquisition, and what the market may reprice the stock to, you can basically see at this 8% interest rate, the market cap could actually trade a little bit under to $18 billion. And at this higher 10% interest rate, well, that could actually mean that basically the market cap goes down to about $10 billion, which is pretty much what GME is at right now. And this would mean that in reality, if eBay shareholders then sell right away, they're really only receiving $22 per share versus kind of the $62.50 they're promised, or $37.91 in share-based, kind of equivalent compensation versus the 62.50 they're promised. And in these two scenarios here, well, GameStop holders would receive quite a significant haircut, and they would be down, 58% to 76% on their positions. But would be kind of short-term pricing, and I think this will kind of be the hurdle where eBay shareholders may actually accept this deal. And this is kind of where in the short term, the stock could potentially revert to this low, which, you also have to factor in that even though it looks like, hey, we're getting $60 a share right now, if you believe the stock would be repriced based on more of the net income, you would say, hey, well, I'm actually receiving a lot less than that. And, basically the acquisition isn't going to go through. But, that's basically all up to speculation at this point. It just gives you some food for thought. So next, we're going to look at basically what is currently the current standing of eBay and what are the expected growth rates that will occur under the current, basically, eBay ownership right now. So what shareholders could expect to return versus under Ryan Cohen's basically plan. So basically right now, eBay's current EPS is sitting at 552 and their December 2030 projections, 5 years in the future, is basically 918. And that is expecting a total growth of 66% or a compound annual growth rate of about 10.7%. And this does exceed the revenue growth of 35%, which, that's basically saying their revenues are going to grow at 6.1% compound annual growth rate because eBay does a lot of share buybacks. And well, what's going to happen basically in the future? Well, I would not expect any share buybacks, and I would actually expect more share issuance for a variety of reasons. First of all, with all this debt you basically have, you don't have any of that excess cash flow anymore to do any share buybacks going forward. And also, it's not in Ryan Cohen's best interest to do any share buybacks, because if you actually look at kind of his, reward plan he can get, his reward is based on the market cap and the EBITDA. And that's why this type of deal is very attractive to Ryan Cohen, because as you'll see in the little calculations I'll show, the dilution actually doesn't hurt him very much. But share buybacks do not increase the market cap, increases the value per shareholder, but doesn't increase the market cap. Actually, more share dilution, that's a way to increase the market cap. And all the debt also isn't a concern because EBITDA includes debt and is basically before the debt. So this $2 billion of debt, they or interest expense they may be basically paying. Well, this EBITDA calculation is before that. So those aren't a concern for him. And it kind of does show, in my opinion, that he's not really aligned with actually the GameStop or the shareholders' best interest based on these type of performance metrics, because he can just dilute more and it actually helps him meet his goals easier with these leveraged buyouts, but the shareholders won't actually see as many of the results. So now basically we're going to look at two different scenarios here. So I have basically RC's plan, which his plan is over the next few years. It kind of acts like it's going to happen instantly, but remember, GME was a 5-year turnaround. He hasn't worked in a company as big as eBay before, and it's probably not going to happen overnight. It's going to take a few years. We'll probably see, 5 years, at least 5 years. His plan for sure would basically be able to play out with the cost cutting. And basically he's talking about cutting, up to $2 billion of expenses. So kind of in this plan here, I'm saying, okay, well, the interest rate, could be up to $2 billion, and his cost cutting is basically pretty similar to that. So we can just kind of, factor those two things out as a wash. So in this plan here, basically of growing, a compound annual growth rate of 3% per year, the also one is basically continuing to grow at the 6.1% per year and have the cost savings basically on top of that. So that's a little bit more optimistic because we're talking about cutting, sales and marketing and this and that. Well, eBay didn't maybe grow very much, but that maybe is one reason they maintain basically the current buyers on their website, or those buyers maybe bought a little bit more. So it is very possible they would slow down in growth if you basically did cut $2 billion in expenses. And basically we take, this would be the after-tax earnings, basically I calculated, you would have within basically 5 years. And then we kind of look at, what the growth is from that and how this kind of divvies up between the shareholders, because this would be currently a market cap of about just under $56 billion, and kind of how this would divide up between the different shareholders as well. You basically have, the eBay shareholders portion, and you have, and they're basically, this is their kind of market cap cost basis, because this basically factors in of what the value is of the shares they're getting minus the cash that's basically taken out. And basically that gives their a total growth of 122%. And then they would hypothetically be receiving under this plan here, and this is us also assuming this, they get 75% of the stock, they would get about a 17.3% compound annual growth rate, which obviously would be better than the 10.7, but this is, basically not proven yet. And then also you kind of have to factor in that if Ryan Cohen were basically to get his full stock comp package, that would actually dilute the shareholders for eBay and GameStop more, and they would be receiving about a 15.1% compound annual growth rate instead. And we can actually change this number here to show if it were to, eBay shareholders were to receive less, and this is actually one reason they probably wouldn't want to receive less. If we cut this down to 60%, you can see now, actually all the numbers basically on this change, and their return they would get after the RC dilution, Ryan Cohen's dilution here, would actually be 8.7, which would actually be lower than what the current eBay projections are. So that kind of is one reason that you're going to probably be requiring about 75% of this new company actually be owned by eBay shareholders to even start making it enticing for them. And then on the game shareholders basically front here, they would, in this situation, realize a compound annual growth rate. And this is over basically 5 years of 5.6% per year. Or if we were to factor in basically dilution of him receiving his entire comp package, though the comp package is basically over 10 years. So, you kind of have to assume that they actually will grow this to the 100 billion in the future, which would probably require another acquisition to actually do that. You'd really only be receiving basically 4.1% compound annual growth rate. So let's look at basically the more aggressive growth plan here, which is, the current company of eBay growing at 6%. And this is also actually assuming that the GameStop income itself is also growing at the 6% as well, with his cost-cutting measures, basically, which more or less, cancel out the debt. So this would, give them basically this net income after taxes closer to about $3 billion. And you can see how it would work out. Then it gets a little bit more attractive potentially for the eBay shareholders. They get a compound annual growth rate of around 20%. And even with the dilution, they're sitting at 18.6. So this could be a little bit attractive, and this is why I'm saying if you're getting 75%, the deal kind of potentially does make sense if they believe Ryan Cohen can produce the results. Because even if they were actually to grow under this, they would enter the receiving that, and it was actually they had lower growth than this, they actually would still receive above the compound annual growth rate that eBay is currently projecting on their current path. But the unfortunate thing for GameStop shareholders is under these scenarios here, even this faster growth plan here, they would be receiving compound annual growth rates under 9%. As you can see, 8.9 basically without the dilution by Ryan Cohen, or 7.4 with the dilution. So for GameStop shareholders under this type of deal to actually get a reasonable return going forward, they really would need a lot more growth than basically what eBay is currently projecting on top of the cost-cutting plans, which I think is fairly unlikely, which actually makes this a fairly unattractive deal for the GameStop shareholders. Obviously, if we were to switch this up, you change this to 60% here, you can see how these numbers flip here. And then, well, now this isn't really attractive even on this more accelerated growth plan for eBay shareholders, since after dilution, well, they only receive 12%, which is really not worth the risk compared to the 10.7 that's already basically being projected. But then the GameStop shareholders, well, they would receive basically more. So this is kind of a little bit of the battle and toss-up you end up getting, is that, to get the eBay shareholders to accept, you have to offer them more of the company, which means you're going to make basically very low returns off of it versus them, and they need to get some expectations that they're going to have a good hurdle above what the current expectations are. And this is also just showing here basically with Ryan Cohen's, basically, if he got the full package and his current valuation, once it reaches $100 billion market cap, and this would be 5 years in the future, what the value basically of his share of the company would be and how much he would own. So under this kind of, 75% dilution here, well, he would end up basically with a stock-based comp package. He would end up with basically 8% of it. And, that would be about $8 billion for him. I'm not sure how much he basically paid into it, but, that would be a pretty good return. And obviously, if we lower this here, well, his value goes up because he's also diluting himself, less as well, but I don't think eBay shareholders would accept it at that time. So anyways, we're going to see how this is going to go, because eBay itself doesn't have any large core shareholders, mostly just institution with very little involvement basically by management in owning the company. And Ryan Cohen basically has, has and can take a significant stake in the company, the force a vote. It kind of just shows you an idea of where eBay shareholders if they're in a rational world, where they basically may accept may accept the buyout and what would be worth it for them. And you can see we can play around here. I'll just throw in, for example, 70%, where eBay shareholders really aren't quite receiving the full value they're being promised of the 125, but it could be fairly, attractive there. And here, well, 16.5%, if they really were able to pull it off, that would be better than the 10.7. And, this 13% even on the lower growth track, it could be worth it there. So there kind of is some worlds where they basically, GameStop and Ryan Cohen could make a realistic offer for eBay kind of based on what he's proposed right now, that they would want to basically accept the offer. But in most of these scenarios, you can see that the returns for the GameStop's shareholders would be quite low. And then you also have to factor in, which I haven't factored in here, is that, well, the market cap, even in this more aggressive position, is $65 billion, and there would still only be 5 years to reach the $100 billion for him to get that full payout, which means Ryan Cohen's probably going to basically be looking at doing another acquisition and some more dilution. So that would kind of vary this up a little bit more, but this is just kind of like a starting point to look at where the different basically shareholders are going to basically be aligned and what would be worth it for them. So you see, it could be worth it basically for the eBay shareholders. And other thing I'll say before I'm repeating myself too much, is you can see with the payout that Ryan Cohen's basically getting is quite a bit better basically in comparison than what the GameStop shareholders are getting, because you're getting kind of at the end of the day maybe market returns in the best case scenario, where he gets effectively 10% of this company. Well, he does own some right now. It gets bigger, then he gets this 171 million more shares. He would own a large portion of it. He's really the one that's basically coming out ahead at the end of the day. And also, these numbers do change if you were to basically lower the PE. If you were to say, well, it's trading a little bit lower in the future, 16.9 PE per se, you can see how these returns also get a lot lower in the future, and it becomes much more unattractive basically for eBay shareholders to accept the deal, let alone basically GameStop shareholders. Usually, I don't think most of them are looking at this. Maybe after this video, you'll consider it. But you can kind of see that at a lower PE, also 5 years in the future, you'd kind of be getting a bad end of the stick there. But you could also, play at the other end of it at a higher PE, call it a 27 PE ratio, where then it does start actually looking a lot more basically attractive. And this is one of the ways they would get a lot closer to that $100 billion market cap. So anyways, that basically kind of shows where the threshold for eBay shareholders to accept this deal would be, and gives you a rough idea of the returns that therefore the eBay shareholders may be looking to get, and then the GameStop shareholders would get. And I think if anything, if the deal does want to go, basically eBay shareholders do want to accept it, well, they have to get the upper hand of the stick, and that's going to be at the cost of the current GameStop shareholders. But in looking at all of this, if you were to get basically this deal to somehow go through, that he does do this, large buyout, and it were to get repriced down to quite a bit lower market cap, not more moderate one up here, which is originally being priced at, but kind of the market then sells it down more. This would be actually an interesting place to, buy this new company, because you would be potentially getting a lot higher returns than this per year. So anyways, that's my thoughts on this GameStop eBay merger, and kind of with this little, napkin math Excel sheet here, kind of how it could break out. So anyways, I hope you liked the video. Subscribe to my channel, and I will see you in the next stock analysis.